Every company you see in this frame cannot make their most important product. Not because they lack the money, not because they lack the engineers, because there is exactly one company on Earth that can make it for them. One company, one island, 110 miles off the coast of China. And if that island goes dark tomorrow, whether from a natural disaster, a naval blockade, or something worse, most experts put the runway at somewhere between 30 and 90 days before the most advanced product lines in the world start shutting down. Every AI chip, every premium smartphone processor, every data center GPU powering the model you used this morning, gone. Today, I want to show you exactly why that is true, why the market both understands it and refuses to fully price it in, and whether TSMC, at its current valuation, is one of the most asymmetric bets in the semiconductor sector, or a risk that should stay out of your portfolio entirely. The answer is genuinely not what most people expect. Welcome to the Equity Lab. Every week on this channel, we go inside the infrastructure that actually powers the AI economy, the supply chains, the capital flows, and the companies that most finance channels skip right past because they are harder to explain than a stock ticker. Hit subscribe now because what I am about to show you about TSMC is something most semiconductor analysts completely missed. Let me give you the number first, and then I want to show you what it actually means. TSMC manufactures over 90% of the world's most advanced semiconductors. Not some of them, not most of them, over 90%. Now I know that number sounds like a statistic, so let me make it concrete. Apple's M4 chip, the one powering every new Mac and iPad, is not made by Apple. Apple designs it. Apple owns the intellectual property, but the physical object, the silicon, is fabricated by TSMC in Taiwan. Apple, the most valuable technology company on Earth, does not manufacture its own most important component. It outsources that entirely to a single supplier on a disputed island. Nvidia's Blackwell GPU, the chip every major AI lab is racing to get their hands on, not made by Nvidia. Made by TSMC, AMD's MI300, Qualcomm's Snapdragon, the chips inside Google's data centers. Every single one of them manufactured not by the company whose name is on the box, but by one foundry, on one island, with one flag. This is not a geopolitical opinion. It is a supply chain fact sitting inside every portfolio that owns Nvidia, Apple, or AMD, whether the investor knows it or not. The question I want to answer today is why this happened, why it cannot easily be undone, and what it means for your money. Now here's the question I get most often. Why can't someone just build another TSMC? Samsung is trying. Intel Foundry has spent tens of billions trying. Neither is close, and the reason is not money. You could write a $100 billion check tomorrow, and you still could not replicate TSMC's manufacturing capability within this decade. Here is why. Semiconductor fabrication at the leading edge is not a process you learn from a textbook. It is 40 years of empirical knowledge, tens of thousands of micro decisions, process adjustments, and material innovations, each one built on the last, that live not in documents, but in the muscle memory of TSMC's engineers and the calibration data embedded in their machines. The industry has a term for this: yield. Yield is the percentage of chips that come off a wafer working correctly. It sounds like a quality control metric. It is actually the entire business. A fab that yields 60% on an advanced chip loses money. A fab that yields 85% makes extraordinary margins. TSMC consistently runs some of the highest yields in the world on the most complex process nodes in existence. That advantage cannot be replicated quickly. Without it, even a perfectly funded competitor is burning cash. But here's what makes this story stranger still. TSMC's role has changed. They are not just printing silicon anymore. And the shift that happened quietly between 2022 and 2024 fundamentally changed who TSMC is and what they actually do. This is the part most semiconductor analysts missed entirely. To understand this, I need to tell you about a problem Nvidia ran into. AI chips have reduce performance. It simply does not exist. TSMC is not printing the book anymore. They are editing it, binding it, and shipping it. Here is the proof. In 2023, every major AI lab was screaming for Nvidia H100s. The lead time from order to delivery stretched past a year. Everyone assumed the problem was GPU die production. It was not. The dies were ready. The bottleneck was CoWoS. TSMC's advanced packaging capacity was simply maxed out. The entire AI build-out of 2023 was not constrained by chip design or semiconductor fabrication. It was constrained by an advanced packaging process most people had never heard of. With Blackwell, that dependency is even deeper, because now the chip itself requires CoWoS to exist. So if TSMC is as dominant, strategically irreplaceable, with deepening moats and structurally growing demand, why doesn't it trade like Nvidia? 3 letters: risk. Depending on the metric and the peer group, TSMC trades at a meaningful discount to its Western counterparts, somewhere in the range of 30 to 40% on a forward earnings basis. The exact number moves, the direction does not. Same margins, similar growth trajectory, the same central position in the entire AI economy. And almost all of that discount traces back to one variable: geography. If you are an institutional investor managing a pension fund in Boston or a sovereign wealth fund in Oslo, the question is not whether TSMC is the best semiconductor manufacturer on earth. It clearly is. The question is whether a factory in Hsinchu, Taiwan, is an appropriate place to park $100 billion of institutional capital, given that Beijing has repeatedly stated, publicly, formally, at the highest levels of government, that it intends to unify Taiwan with the mainland, by force if necessary. That question does not have a clean answer, and markets hate unanswered questions. TSMC knows this, and they are spending extraordinary sums to address it. Arizona, Japan, Germany, 3 major overseas expansion projects running simultaneously, driven not by cost efficiency. Overseas fabs cost significantly more to operate, but by a message their customers, investors, and their own government all delivered at the same time. You cannot be the single most critical infrastructure company in the global economy and exist in one time zone, on one island, with one geopolitical